Government bonds. Government bonds are a type of investment where you lend money to the government, and in return, the government promises to pay you back with interest after a certain period. Think of it as you giving the government a loan, and they agree to return it with a bit extra interest over time. How government bonds work. Buying bonds. The government issues bonds to raise money, and people or institutions buy them. By buying a bond, you're lending money to the government. Interest payments. Bonds have a set interest rate, so you earn a regular amount of interest from your investment, either at a fixed rate or one that changes over time. Getting your money back. After a set time. For example, 5, 10, or 30 years, the government repays you the original amount you invested. This repayment time is called the maturity date. Pros and cons of government bonds. Pros. Government bonds are seen as a safe investment because they're backed by the government, which means they're less risky than other investments. Cons. If inflation rising prices occurs, the value of the interest you earn may not keep up with it, which could mean lower actual returns. Also, if interest rates go up after you buy your bond, its value might drop if you decide to sell it before maturity. Differences between government bonds in other countries and Japan. Interest rates. US and Europe. In places like the US and Europe, bond interest rates are generally higher and can change based on the economy and inflation. For instance, US Treasury bonds are popular worldwide as a safe, easy-to-trade investment. Japan. Japan has kept interest rates very low for a long time, which means Japanese government bonds have low returns. Japanese banks and financial institutions are the main buyers of these bonds since they prefer the stability they offer. Credit ratings. Credit ratings show how likely a government is to repay its debt. Countries like the US and Germany have strong ratings, meaning their bonds are considered very reliable. Japan's rating is a bit lower because of its long-standing low-interest policies. Who buys these bonds? US and Germany. These countries' bonds are widely held by investors and central banks around the world. US Treasury bonds, in particular, are a key part of the global financial system. Japan. Japanese government bonds are mostly bought by Japanese banks and insurance companies, as they rely on the bonds for stable returns. Types of bonds. Other countries offer a variety of bonds, like inflation-linked bonds where payments adjust with inflation or very long-term bonds. Japan offers a mix of bond types too, including bonds for individuals, bonds with adjustable rates, and discount bonds. Key differences summed up. Interest rates. Japan has very low rates, while the US has rates that reflect its economy. Who holds them? Japanese bonds are mainly held by local banks, while US bonds are popular with investors around the world. Global role. US Treasury bonds set a global standard, while Japanese bonds mainly support the local economy. Overall, government bonds are a safe place to put money, backed by each country's government, but their benefits and uses differ depending on the country. Japan's bonds are very stable but have low returns, while US bonds often have higher returns but may be affected by inflation and changes in interest rates. Useful expressions. Government bonds are a low-risk investment. Buying bonds means lending money to the government or a company. Bonds pay interest regularly to the investor. The bond's maturity date is when you get your money back. US Treasury bonds are popular around the world. Japanese bonds usually have lower interest rates. Inflation can affect the value of bond returns. Some bonds have fixed interest, while others have variable rates. Bond ratings show how safe the investment is. Long-term bonds are sensitive to interest rate changes. Central banks often hold bonds as safe assets. Companies issue corporate bonds to raise funds. Selling a bond before maturity may result in a loss. Investors choose bonds for stable, predictable returns. Interest rates can impact the value of existing bonds.